Hi there and welcome to the Stock Club podcast. I'm James and with me this week is my Wall Street co-founder and chief investor Emmett Savage and our head analyst Rory Carroll. In this week's episode, we're talking about the reasons why the Nasdaq is nearly back at all-time highs, why Warren Buffett sold all of his airline stock, and the dangers of investing in pharma companies like Gilead Sciences. So guys, before we get started today, I just wanted to quickly get your thoughts on the recent news that Uber is trying to buy GrubHub. Rory, I saw you had a tweet up last night that said Uber was trying to diversify its losses by acquiring GrubHub. You're not a fan of this potential acquisition?
Well, you've got two companies who are losing billions of dollars every quarter. Uber went and raised, billions of dollars from investors. A few weeks ago, they fired 20% of their workforce. Now they're trying to take over what their biggest rival in the food delivery space, which is, as we've talked about, incredibly unprofitable. They're probably going, if that deal goes ahead, they'll probably fire half of GrubHub's workforce. And, it's probably they've just figured out what they should have figured out years ago with the ride hailing, which is that it only works in a monopoly. At one point, Uber had Lyft essentially over the barrel and were about to become the only, or pretty much the only ride-hailing company in the US. At least Lyft was in huge amounts of trouble. They even offered to sell themselves to Uber at one point, I think. And Uber messed it up when they, started getting involved in politics. And there was a lot of rumors about sexual harassment in the company, and people started abandoning Uber, and Lyft got a sudden boost in users. So this is them, the circles come around again. They've realized Uber Eats will never be profitable when they have to compete with the likes of GrubHub and Postmates and DoorDash. So, yeah, they're just trying to close off the competition. I can't imagine it would get past antitrust, having the two biggest food delivery companies in the US. Although they could prove that neither company is going to work out without them combining, in which case they could get around it.
So I don't think we'll be adding Uber to MyWallSt anytime soon by the sounds of that. Let's move on to chat then about the kind of market at large. So it's actually almost 3 months to the day since major US indexes began their descent in what then became the fastest bear market in history. Currently, however, the Nasdaq has since recovered nearly all of these losses and is sitting about just 8% off its all-time highs. Emmett, considering the coronavirus definitely hasn't gone away yet and most businesses in the US haven't even reopened, what's driving the market up like this?
Well, I think what's specifically driving the Nasdaq 100 index is the constituent parts. I mean, when you look at the companies on the Nasdaq and the biggest, just allow me to just read the top 10 companies listed on the Nasdaq, from largest down to 10th ranking. It's Microsoft, Apple, Amazon, Facebook, Alphabet, Intel, Nvidia, Netflix, and Pepsi. And if you just think about that mix alone, which they do a vast amount of their business collectively through digital sales, that's less disrupted by the shuttering of restaurants, pubs, hotels, airlines, cruise liners, the constituent parts of the Nasdaq. And so it continues, like PayPal and Tesla are in the Nasdaq. And as a result, and historically, the Nasdaq was the tech-heavy exchange, or the exchange favored by technology companies. As we've seen, it's those technology companies that have rebounded or in the process of rebounding faster than older world industries, which are more likely to sit on the New York Stock Exchange and are indeed represented by the Dow and all the different variations of the Dow indices. So the Nasdaq has bounced back, and it's really down to the companies within.
Yeah. So, like when you consider the last few months, so the number of US jobless claims since mid-March has been 33.3 million, or about 20% of the US workforce. And I suppose a lot of people are confused when there's such economic stress on the country to see the stock market, bouncing back so fast. How kind of do you explain the discrepancy between those two things?
The discrepancy is the biggest, I suppose, logical anomaly that I've seen in my investment life. It is very difficult to marry the economic realities that we're observing, or at least the longer implication of what we're seeing with respect to the easing that the US government has committed to, and how in fact stocks are responding. It's an uncomfortable time. Rory and I were talking yesterday. In fact, three of us were talking yesterday about selecting stocks in this environment. I mean, I feel it's analogous to being a flower picker in a hurricane. Like, you're trying to select quality businesses that have predictable growth, only to find that they're responding in an absolutely hyper-exaggerated way to what's another quarter's report, effectively. And there's a stock that Rory is very interested in, we're both very interested in, but the minute it seems we look at something, it's gone up. It's like we found a magic formula for making stocks grow. We look at them, and it's very it's a very uncomfortable time. It's a very uncomfortable time to be a stock picker and an individual investor. It doesn't mean it's a bad time. It's just uncomfortable because there is such a separation between economic realities, macroeconomics, and then microeconomics, which is the game we're in, which is looking at businesses for the long term.
Yeah, Rory, you are. Sorry, go on.
Sorry, yes. I think there's definitely a feeling in investing circles that definitely in this year anyway, they're not going to let the market go down. This is an election year. Whatever needs to be done to make sure the market doesn't go down is going to be done. And that's, I'm not a macroeconomist. I wouldn't want to be part of any macroeconomy club that would have me as a member, but it doesn't sound like a healthy way to run a country or run an economy. So yeah, look, there's positives as well. We are seeing countries in Europe open much faster than people predicted. Emmett, you mentioned the companies that are in the Nasdaq in particular. Like, a lot of those companies had very little disturbance to their actual workflow. They were all, the top 10 were all pretty much set up to work from home, as us being a tech company were as well. Our biggest disturbance was we all went home and just kept working. So those companies in the Nasdaq weren't as impacted as, let's say, some of the more old world industries, the retailers and the restaurant sector. And some companies are benefiting from this. Amazon is going to benefit in times like this. Even with Bezos telling shareholders, hold on to your hats, people. We're going to be investing all our money for the next couple of months to deal with this. The stock's still going up because it's gonna benefit from everyone staying at home and everyone. Amazon's definitely taken a lot more of my money over the last couple of months anyway. And you look at companies like Apple as well. The speed at which China reopened was certainly a shock to a lot of people, and there was a big worry about Apple's supply chain, which now doesn't seem to be too much of an issue. So there are positives coming out of this. Things aren't as bad as I think a lot of people first predicted they were going to be, but we still don't know the long-term impact of this. And so yeah, it's slightly worrying to see the market rebound quite so quickly.
Yeah. One other thing, Rory, I just wanted to say was that you often call the stock market a forward-looking machine. Is it sometimes wrong to compare, the economic situation right now with the stock market? Is it a case that often when the stock market's going up, people are looking a few months down the line already?
Yes, the stock market's always forward-looking. They don't care about what's happened in the past, really. The past can only inform your predictions for the future, and future is what it's all about. You only invest for the money you're going to get, not the money that's been made already.
Yeah.
I suppose there's probably an element of, you mentioned the 33 million that have filed for unemployment in the last 7 weeks. That is, 1 in 5 working Americans is now unemployed. There's probably a feeling that if the country's going to reopen as quickly as, certain politicians think it's going to reopen, that number is going to, come down very rapidly. So, that's something that could be a positive view for people investing. Now, I don't think it's going to happen that quickly. You're not going to get back to full employment anytime soon. And that's going to dent the economy. And even those tech companies, like Amazon, can do well in a lockdown because people can't go and shop at Nordstrom or Macy's. But it's when you have an economy where people are making less money and people are less secure in their employment, Amazon's going to get hurt. That's just the way it's going to be, So yeah, it's a forward-looking mechanism, and it doesn't like uncertainty. And so that's I think is what's most surprising, is that it's become very comfortable with how much uncertainty there is right now.
Yeah, absolutely. So, speaking of the market at large, let's move on to one of the industries I suppose that's been most hit by it. So, Berkshire Hathaway held its famous AGM almost 2 weeks ago in Omaha, Nebraska. This year was a little different, however, with the event live streamed completely on Yahoo due to social distancing restrictions. The biggest news that came from this meeting was that Berkshire has sold its entire stake in the airline industry, a stake that was worth about $4 billion at the end of last year and spread across giants like Delta, United, American Airlines and Southwest Airlines. In explaining kind of why he's divested himself of these, Buffett said that the world has changed for airlines and he doesn't know if Americans have now changed their habits or will change their habits because of the extended period. How much of a hammer blow is this, Emmett, for airline stocks if America's most famous investor doesn't see a future in them?
Well, it's big. I mean, it will influence the thinking of other retail investors and even institutions. I mean, we all look to Warren for at least thought leadership. So it's impossible not to. I mean, you have to take his word, and you realize that there's a lot of thinking in that. I mean, he said specifically on that call, and I listened to some of it, and I quote, "We will not fund a company where we think that it is going to chew up money in the future." And effectively, he was referring to divesting all the airlines in that statement. And I think the real problem is that airlines at this moment can't control the situation that they're in. They need to borrow a lot of money. And I think one of the main reasons that Buffett sold his shares was that of the airline bailout loan terms, and in their giant borrowings, the airlines now not only have record low passenger levels, but the federal government is getting warrants that they can eventually own the airline stock if they default. So that is a deterrent for Buffett. So we, as a collective community of retail and institutional investors, listen to Buffett, and him dumping 4 airlines en masse. Really, you can't ignore that. You have to realize this is something really big. I mean, there are other concerns he has, like there's too many planes, the fleet sizes, their ongoing maintenance cost, how in fact are they going to deal with an excess inventory of planes over the short to medium term is one of those other factors in the equation. I mean, I was looking at here, Ryanair. Ryanair is the global poster child of operational excellence. You know, it has massively outperformed its peers. When you look at Ryanair's stock compared to companies such as Southwest and JetBlue, it's left them in the dirt. It is. It's a business we here in Ireland are very familiar with, because not only is it an Irish business, but it has I suppose, a personality CEO in Michael O'Leary, and is known to virtually everyone who's an adult in this country. And I looked at Ryanair's stock specifically because it is the poster child of performance, and it's grown about tenfold in 20 years, and that's taking the year 2000 low to the very recent January 2020 high. So let's ignore the downturn. So airline, the best performer over 20 years has grown tenfold in 20 years, which is a CAGR of about 12%, compounded annual growth rate of around 12%, which is good for sure. But that's the best. In that, I didn't look at every single airline, but I looked at about a dozen. And when you take that is the poster child of operational effectiveness with a 12% CAGR over 20 years. I think that Warren broke one of his own rules. He originally said he'd never invest in airlines. He changed his mind. He bought heavily into 4. And I think he probably is lamenting that decision. And I suspect one of his advisors, one of his potential successors, brought those to the table. And as most people know, you have an inner voice if you're good at something. We've all experienced this thing where we've taken advice that's contrary to something you really believe yourself, and only to find you were wrong, or you were right and they were wrong. And I wouldn't be surprised if that's happened in Berkshire Hathaway, to be honest.
Yeah, this is something we mentioned, Rory, when we were preparing for this podcast, that Warren Buffett, he's quite good at accepting, I suppose, his mistakes, his investing mistakes.
Well, this one definitely faster than most. He was a big shareholder in IBM for a long time, which continuously just went down. He's still a big investor in Kraft Heinz, which is having a very bad time as well. In terms of airlines, he was famously against airlines for an awful long time. And I think he saw something or at least someone pointed out to him some of the kind of structural changes that the industry had made that was starting to make them become more of a profitable business. Was yield management that was pioneered by Southwest Airlines and then brought over to the Europe by Ryanair, where you could basically fill up a plane at different price points. The fact that they were able to kind of squeeze extra dollars out for things like special seating or for bringing on baggage. So, and then airline leasing as well was this huge change to the industry that meant that they weren't holding on to these constantly depreciating assets from day one till the point at which they were sold for scrap. I did see someone, I can't remember where I read this, but someone actually, did make the point about Buffett's airline play that, everyone sees investing through their own realities, and Buffett, as a kind of 90-year-old man, would be in the very high-risk category for coronavirus. And we know he's quite the hypochondriac as well. Actually, if you ever see any interviews with him, he's got a long-standing fear of, or I don't know if it's fear, but he thinks about his mortality quite a lot. And perhaps that has kind of, influenced this decision. If he's thinking of himself, would he ever get back on an airline? Probably not for a long time. So I can't remember. I can't attribute that because I can't remember where I read it, but I thought that was an interesting take on it.
Yeah, absolutely.
I mean, he has his own private
I don't think
he won't be getting on a Delta airline anytime soon.
I don't think he'll be worrying about getting the middle seat in a row anytime soon. Speaking of that, actually, it was really interesting as well that at the AGM, Charlie Munger wasn't there. Obviously, he's 96, I think he is at the moment. So it was a bit of a risk for him to go out. But Warren mentioned that he started using Zoom recently, which I think is quite a mental image, Charlie Munger using Zoom. Let's move on to some better news then. So Rory, one of the most recent additions to the MyWallSt shortlist was a company that, to be honest, I was very skeptical of at the start, but you've been a long-term fan, Peloton. So it looks like you might have picked the exact right time to add them too, because the stock has been up almost 50% in less than a month. A lot of this was attributed to a great earnings report the company had a few weeks ago. How good is Peloton looking for you at the minute?
Yeah, there's times when even when we're not market timers, but we probably should be. Sometimes we're very good at this for people who don't do it. It was a really good report. I've been a big fan of Peloton even before they IPO'd. I was really interested in the company because I think they really cracked that connected fitness industry that people have been trying to get into for years. They've matched the hardware with the software and with the experience. And Peloton's one of those companies that it's really interesting is that when you're analyzing as a stock, because it's got one of those elements to it that people instantly dismiss, and those come along quite rarely, where you've got a well-known company that there's one part of the business that you mention to people and they just go, oh, that's stupid, that's a ridiculous idea, why would that work? And an awful lot of times that's hiding what is quite a good business, and with Peloton it was certainly the high price of their bikes. So it was over $2,000 for one of these exercise bikes. And, the instant cry was no one's going to pay $2,000 for an exercise bike. And clearly that's not true. They sold $420 million worth of them just last quarter, which was up 61% year over year. The numbers in the last report were great, really good. They saw subscriber numbers go up, but from I think it was 457,000 to 886,000. The quarterly workouts went up from nearly 18,000 to 44,000. And the average monthly workout by subscribers gone up from about 14 per month to about 18 per month. So you're seeing literally every single engagement metric just skyrocket. I think the long-term story for Peloton is that it will become a subscription business. At the moment, they're still very much a hardware business. The sales of their bikes and treadmills still represent about 80% of revenue, but subscription revenue is growing at 92% per year. And remember, that subscription revenue stacks. So everyone who buys a bike this quarter becomes a subscriber, and based on their current churn numbers, will still be a subscriber next year. They also have a 90-day free trial for subscribers, so we haven't seen the big impact of the last quarter of people actually going on to pay for subscriptions. So there's lots and lots to like about the business. And the bear argument at the moment is that, well, of course they had a good quarter. Why wouldn't they? This was, there's times when you're investing in stocks where you're holding a position in a stock and you give them a bit of leeway when they have a few bad quarters or things aren't going well for the business and you're looking for a turnaround. And at some point you've got to look and say, well, like if they can't do it now at this perfect point for them, this point when everything should be going right, then they're definitely not going to work out over the long term.
That was the exact argument we made with food delivery companies.
Yeah, exactly. It's that if not now, kind of when argument. With connected fitness, this is their quarter. It's like if they hadn't performed well this quarter, you really would be asking, if not now, when. So I wouldn't. Well, first, again, we don't know how long this whole thing's going to go, but I wouldn't suspect you're going to see as good quarters going forward. This was really the quarter where it was like, right, people are locked in their homes. They need to do exercise. There's this company that's selling a bike that's going to sort all that stuff out for you. So you would suspect them to do well this quarter, and they have. But yeah, I don't buy the idea that this is just going to stop once coronavirus is over. I think people love this product. It's got a great brand. It's going to have network effects and halo effects going forward. And yeah, I'm a big fan of it. It's a pricey stock, but I like the business.
I think
Would you buy a Peloton? Sorry, James.
I actually looked into it. They don't deliver in Ireland just yet. They're in the UK, but not Ireland. I would. I actually would. Yeah. I think it's a really good product. And everyone I know who has one, or people on Twitter who I follow, Ben Carson, who writes for A Wealth of Common Sense, bought one and said it's one of the best things he's ever bought. Ben Thompson from Stratechery says loves it, thinks it's a fantastic product. So people who I respect and listen to have purchased them and absolutely love them.
Would you buy one, Emmett? You have a product similar, do you?
I did. Yeah, I kind of came to a buyer's decision. I decided to go with a competitor, a much smaller business, nowhere in the same league economically as Peloton. It's called Carol, and its website is caor.o.l, and they have an AI bike. It's priced at the same level as Peloton. Its subscription is kind of the same level, but it uses AI system to measure your resistance, and I guess its angle is that it's what was the something about Mary, like the 5-minute abs and 4-minute abs, like with the Carol you
7-minute abs.
Yeah, so there's only so this is the 40-second workout. I mean, seriously, I didn't believe it till I bought it. So they basically push you to the extreme for 20 seconds, then they give you a kind of a 2-minute 40-second downtime, and then they push you to the extreme for another 20 seconds. And if you can believe, you'd need to lie down flat on the floor on a couch right after doing 40 seconds exercise. That's Carol. But I've had 65 rides on the bike now at this stage, and definitely feeling my physical fitness and general physique changing for the better.
Probably should point out this podcast is not sponsored by Carol. So just
I'm going to ring the CEO and ask her, can she?
You really should start coming out to some of these companies whose stocks were pushing up all the time and start advertising on us.
We'll just send an invoice. So one more thing I wanted to chat about then, Rory, was earlier this week, you wrote a great daily insight about the importance of investing in companies and industries you properly understand. I suppose this has become quite relevant recently with all the talk of an antiviral drug, specifically in relation to Gilead Sciences. What exactly are the difficulties of trying to invest in a pharma company like Gilead?
Besides from just investing in a pharma company, I think one of the big mistakes novice investors make is that you think that you try and make information arbitrage. Essentially, you think that knowledge will give you an up against other investors, even though it's like publicly known knowledge. You know, it's the whole thing about like, well, I'm going to invest in Apple because they're going to bring out a new iPhone at the end of this year. That's not a solid investment thesis, because everyone knows they're bringing out a new iPhone at the end of this year. That's already been priced into the stock. The only way you'd have an advantage with information is that if you knew something that no one else knew. So if you had a friend who worked at Apple who told you that there was some amazing new feature that no one knew about yet, but was going to see share the demand for iPhones skyrocket, then you would have an advantage over someone in information. And unfortunately, if you traded on that information, you'd probably go to jail. So don't do that. So when you see like a headline news like company develops drug that fights coronavirus and think that that's going to you're going to have an advantage against other investors on that, that's just not true. That information has already been seen by people who are specialists at investing in pharmaceuticals. They've digested this information and they've already made the moves before you've even thought about it. So that's kind of like the overall. Well, that was like the overall theme of the piece, was that, you know, information does not give you advantage. Information should be used when investing. You should take lots of information and form opinions for the long term, but information is not going to be able to make you a quick buck. And if you take the example of Gilead, Gilead, the news was that a drug that they had actually developed for Ebola, or they were developing for the Ebola virus, had positive effects on patients that had already got coronavirus in 2 separate tests, and that it was going to be kind of greenlit to deal with patients who are very seriously ill. This isn't, you know, when you're talking about something like coronavirus, very careful to distinguish between, like, this is not a vaccine. You know, you can't take this before getting coronavirus. It's not a cure either. It doesn't cure coronavirus. It helps people in the most serious conditions get better faster than without it. Yeah. And not necessarily all the time. If they weren't going to get better anyway, this might not even ensure they get better. It just could increase or decrease the amount of time it would take for them to see better results. So that's like the headline story. But, you know, to invest in Gilead based on that would be very, very short-sighted, because Gilead is a massive company with, you know, over $100 billion company. They sold $5.6 billion of drugs last quarter. The vast majority of that was through sales of their HIV products and their hepatitis C products. So this, even if this does become a big drug in the fight against coronavirus, will represent a very, very small part of their revenue. And then there's so many other things to consider. You know, like, what if a vaccine does come out over the next 6 months? This drug essentially is useless. It's not going to have any impact. You know, so this, you know, pharmaceuticals is one thing that I think most investors, unless they worked in the industry or unless they have, you know, a PhD in biochemistry or pharmaceuticals, should really stay out of, because there's so many factors that you just don't understand as a layperson. You don't understand how the drug industry operates, how drugs get from concept to development to market. You don't understand FDA regulations. You know, most drugs takes, I think, 10 years to go from their first development to actually being on the shelves or being able to be sold to people. And a very, very small percentage of them actually make it through that process. And it costs, I think I saw somewhere, it costs $350 million from day one to getting it on the shelf. And even then you have to start thinking about, well, is there competitor drugs? What's the patent law? When's it going to run out? What's some countries will allow the drug to be used, some won't. Some will have it as prescription, some will have it over the counter. There's so much information to deal with, and you're competing against these guys who have all this information, who have been doing it for 30 years and know everything about the industry. It's very, very hard for you to find an edge in an industry that you don't understand. And pharmaceuticals is definitely up there as one of those industries that very few people have a firm grip on.
Absolutely. So let's move on then. Don't forget, actually, you can read that daily insight Rory's referencing there. It's called Always Invest in What You Understand. That's in my Wall Street right now. Speaking of daily insights, let's take a quick look at some of the other things happening in my Wall Street at the moment. We have May's stock of the month live since last Monday. This is a mega cap tech giant that might give your portfolio some much needed stability over the next few weeks. We've also just published our stock of the month podcast too. This is an exclusive podcast available only for my Wall Street members, where Rory and I dig deeper into the reasons why we like this month's stock of the month selection. I've included a link for this new episode in the notes for today's podcast, so make sure to go in and check it out now. Jargon busters. So the first one, Emma, I'm going to throw your way. This came in from Leon in Dublin. Thanks for that, Leon. He said, one of the key lessons in our Learn app is to understand and take advantage of the power of compound interest to maximize investor returns. In practical terms, how does one do just that for their portfolio? So I think, Emma, this is something we kind of see a lot is people maybe misunderstanding the impact of compound interest on their investment portfolios.
I suspect this Leon is a very old, one of my oldest friends from Dublin. And if it is Leon, hi Leon. And I know he's a very, very accomplished engineer. So the mathematics of compounding is something he'd understand very well. But I think that the misleading word when we talk about compound interest, as Rory pointed out to me only yesterday, is the word interest. And we're I suppose, raised to understand that when we see the word interest, we know that our banks pay us a certain amount per year for the cash on deposit. So one, in childhood or in teens learns that interest is something you look at. It's a number, you can see it there. But in compounding interest, or compounding magic, as it's often called, it's not quite so, it's not so visible, because it's not that at the end of each year we look at a number and that's the interest on our portfolio. Really what we're looking at is the long term, and the overused, I dread using the word, but there is no other way to say it, the exponential growth that a stock portfolio enjoys over the very long term. So the first few years of any stock portfolio are generally the least glamorous. I'd even go so far as to say your first 5 years as a stock investor are generally a bit of a grind, because unless you are pretty lucky or very unlucky, there's no huge change. It feels like you're just throwing money in and there's small variations. But it's after those years when you get a calculator out and keep multiplying 1 by 1.1 or 1.2, the first time you do it, the first few times you do it, it's small growth. But eventually multiplying a big number by 1.1 or 1.2 results in way bigger growth. And repeatedly over the long term, what we're doing is we're taking out our calculator and we're multiplying our principal capital by 1.1, which is 10% growth, year after year after year after year. And it's in those latter years where you're multiplying a big number by 1.1 to see the growth. So compounding magic is, to Leon's question, taking advantage of the magical power of compound interest really comes down to buying a set of quality companies and leaving them alone. Yeah. And adding to your favorites, or adding new stocks that you particularly like as the years go by. But the greatest investors that I know, the ones who have enjoyed the most, mind-bending returns, are the ones who did nothing, or at least did nothing after they bought. We are fed a constant stream of information about the stocks and businesses we know and like and have generally taken a decision on. And that's difficult, because we're intelligent creatures. You buy shares in Peloton, you get the latest quarterly results, you try to assimilate them. But the best thing you can do to unlock the magical power of compound interest is marry your stocks, leave them there. Don't allow the latest news to sway you. Now, if there's strategic change, that's a different story. But in general, you can take advantage of compound interest by just building a quality portfolio and leaving it alone.
Absolutely. Thanks for that. Rory, second question I'm going to throw over to you. So this came in, and this has actually come in a few times, and it's asking, how much weight do we put on other analysts' recommendations when we're picking stocks for MyWallSt?
I think at the start, when you first hear about a company, the best thing you can possibly do is avoid all other analyst recommendations. Well, that's as an analyst. It's much better to literally get the name of the company and dig into it yourself. The first place I usually start is Wikipedia. Honestly, if you don't know anything about a company, just go on Wikipedia, just read what they do and start to think about it in terms of, does this seem like an interesting business? Then onto their corporate website, read about, try and find what kind of customers they have, what kind of products they have. And then you start digging into the finances and looking into how much money do they make, what's their margins, And once you start developing your own opinions, then you start, reading other people's ideas as well. Being very careful to make sure that you're not falling into that confirmation bias where you're only reading what other people are, what makes your opinion, your original opinion, sound better. And you definitely build up I want to say kind of a cadre of analysts that you listen to more than others. There's a couple over at the Motley Fool that I would, take what they think about things very seriously. There's other investment banks which I wouldn't at all.
Yeah.
I won't name names. But when you think about, well, this, particularly when it comes to things like the Wall Street banks, like the Goldman Sachses and the Raymond Jameses of the world, those analysts typically are setting kind of price targets for a year. That doesn't really suit our investment style. They're very much doing their discounted cash flow models based on what they think a company is going to make over the next earnings report over the next 12 months. If we're invested for 10 years, it's not really suitable to our investing way of doing things. It's interesting to see what they think, but they're much more short term than we're thinking. The answer is at the start, you don't listen to any of them. And then as you start developing your own ideas, you try and kind of, it's particularly to see if you're missing anything. But then again, there's thousands and thousands of people analyzing stocks all the time. So I do occasionally get questions from people saying, why doesn't this analyst at this company not like the stock you like? It's just like, I don't know. I have no idea. I couldn't possibly read all the other analysts,
Yeah.
So yes, it's a give and take with that.
But that same principle applies to everything. You go to a restaurant, you might think it's the most wonderful food ever, and the person you're with might find it very average up and down. And then same for a movie or TV show or anything at all. You'll find a full gamut of opinions on absolutely anything. And I think Rory and I are generally aligned, but we very often disagree on a particular stock, and we know one of us will be right.
Yeah, one of us will definitely be right. Well, it's that whole thing. It's more art than science, isn't it? There is no definite answer. I mean, especially when you think of all the variables that go into, making a stock a good investment. You could have been very like Buffett. You could have been very bullish on airlines until a month ago. Things change.
Absolutely. So let's move on then to our elevator pitch to finish up the show. So I've gone with a different one this week. I've asked you to pick your favorite TV show that you've been watching in lockdown. Rory, I'll come to you first. What TV show are you pitching to listeners of Stock Club?
It's the one I've become totally obsessed with, and I'm sad because I'm coming to the end of it now, is the Michael Jordan documentary on Netflix. I think it's called The Last Dance. Yeah. It's brilliant. I've really, really enjoyed watching that. And I know absolutely nothing about basketball, even though I've written about basketball for investment advice a couple of times. I once wrote a piece where a user had to point out that I'd said LeBron James was retired when he wasn't, which shows how much I know about basketball. But I've really, really enjoyed this. It's a really well made. I love those first of all, I love sporting documentaries.
Yeah,
sports stuff is usually quite interesting, and the mixture. It was filmed back at the time, and now it's kind of been it's kind of found footage mixed with stuff that's been recorded recently. I love that style of documentary filmmaking. It's made by ESPN Films, who I think made the OJ one last year, which was excellent as well. Made in America. That was a really good sports documentary. It's just great. I mean, I don't know what else to say about it. Even if you don't like basketball, I've recommended it to a couple of people who don't watch any sports whatsoever, and they've all said they loved it as well. Yeah, no,
I'm similarly in the dark about basketball, but I've watched it. It's absolutely fantastic. It's on Netflix. Emmett, what TV show are you watching at the moment?
Yeah, well, the absolute answer for me, I guess, is Ozark season 3, which is a very obvious one. I think Netflix sticks it under your nose. It is a great show. It's beautifully made and well scripted. But to my own surprise, I think my favorite in this lockdown period is going to turn out to be an Irish focus show called Normal People, which I'm halfway through at the moment. It's a Hulu. It was commissioned by Hulu and the BBC and is based in Dublin and Sligo here in Ireland. And the storyline is very linear, but the acting and the authenticity is just so captivating. Like it's one of those TV shows where I just couldn't take my eyes off the screen, which is some accomplishment in this distracted world. But I just found it to be absolutely almost intoxicating. I was watching the show, the first 2 episodes, I was like, I don't think I'm going to enjoy this. It's a very simple show, but it's just that every single scene, every single interaction, you can at some level relate to. It's just so real. Maybe it's just an Irish thing, but I think I saw on Twitter that the Kardashians were saying it's great stuff. So
you better be careful. This is a family show. Don't get too into it now.
Oh yeah. True.
Very controversial.
Exactly. It's a bit controversial over here in Ireland, but I think it's very tastefully done. But it's very real.
It's brilliant, but it's definitely not one to watch with your parents.
or your children.
Or your children,
yeah. Or your children, yeah.
Watch it by yourself. So that's about it from this week's Stock Club. Don't forget about all the great new stuff in the MyWallSt at the moment. If there's anything you want us to discuss or explain on the next episode of Stock Club, please make sure to get in touch with us. You can find us on Twitter, that's at MyWallStHQ, or email us at pod@mywallstreet.com. That's pod@mywallstreet.com. Don't forget to subscribe to Stock Club, and if you're enjoying the podcast, please leave us a review or a rating on whatever podcasting platform you listen to us on. That's it from us here today. We'll talk to you in 2 weeks. Happy investing.